You need to understand the scale of what is happening right now because the number isn't billions anymore. It's not even hundreds of billions. We are looking at a $10 trillion bubble that is wobbling, and when it bursts, it's not just going to show up on a stock ticker. It is going to reshape the cost of living, the safety of banking, and the stability of the global economy. Everyone is looking at the stock market making all-time highs, blinded by the dazzling lights of the AI revolution. But if you look at the foundation, the literal concrete and steel that underpins the banking system, it is cracking. We are standing on the precipice of the largest asset correction in human history, centered on three specific pillars: commercial real estate in the West, the housing crisis in China, and the speculative frenzy masking it all. Let's start with the immediate danger, the one sitting right in the middle of every major American city: commercial real estate. For decades, office towers were the gold standard of investing. Safe, reliable, always appreciating. But in 2025, that narrative has effectively died. We are facing a maturity wall that is unprecedented. Nearly $1 trillion in commercial real estate loans are coming due just this year. That is almost triple the 20-year average. In a normal market, landlords would just refinance these loans and move on. But this is not a normal market. These buildings were financed when interest rates were near zero. Now, rates are significantly higher, and the buildings themselves are worth 30 to 40% less than they were on paper just a few years ago. Think about the math on that. If you owe $100 million on a building, but the building is now only worth $60 million, and the bank wants you to pay double the interest to keep the loan, you don't refinance. You walk away. You hand the keys back to the bank. And that is exactly what is starting to happen. We are seeing major institutional investors, the smart money, defaulting on trophy assets in Los Angeles, San Francisco, and New York. They are calculating that it is cheaper to lose the building than to pay the debt. And here is where it gets dangerous for you and me. Who holds that debt? It's not just big Wall Street firms. It is regional banks. The local banks that hold your deposits and finance local businesses hold a massive percentage of this toxic commercial debt. They are playing a game called extend and pretend. They are modifying loans, pretending the buildings are still worth the old price just to avoid marking down the loss. But with $1 trillion coming due, the time for pretending is over. If these banks have to admit the real value of these assets, we could see a liquidity crunch that makes 2008 look like a rehearsal. Vacancy rates are hovering near 20% nationally, a level we haven't seen in decades. The remote work shift wasn't a temporary blip. It was a permanent structural change, and the financial system has not priced it in yet. But if the US office market is a campfire, China's housing market is a forest fire. This is the second and largest part of the $10 trillion equation. For the last 20 years, China built its entire economic miracle on real estate. It accounted for nearly 30% of their GDP. To give you context, in the US during the housing bubble, it was roughly half that. China didn't just build homes. They built entire economies on the promise of homes. But the music has stopped. Major developers like Evergrande and Country Garden have collapsed, leaving behind mountains of debt and millions of unfinished units. Goldman Sachs recently estimated that the unsold inventory of housing in China, if fully built, would amount to roughly $13 trillion. 13 trillion. That is a number so large it is hard to comprehend. It represents millions of ghost apartments that no one wants in cities with shrinking populations. The wealth of the average Chinese household is tied up in property. Nearly 70% of their assets are in real estate. As prices fall, that wealth evaporates. This creates a deflationary spiral. People feel poorer, so they spend less. Companies earn less, so they cut jobs. And the cycle intensifies. China is trying to export its way out of this problem by flooding the world with cheap goods, which triggers trade wars and tariffs, dragging the rest of the global economy into their mess. Now, you might be asking, if the two biggest economic engines, US real estate and Chinese manufacturing, are sputtering, why is the stock market doing so well? Why does everything feel fine? That brings us to the third component, the illusion. We are currently in a market that is being held up by a handful of massive technology companies riding the AI wave. The excitement around artificial intelligence has sucked all the oxygen out of the room. It has created a trillion-dollar valuation shield that is masking the rot in the real economy. Investors are pouring money into AI stocks, assuming that this new technology will generate enough productivity to grow us out of the debt problem. But history tells us that speculative bubbles, even based on real revolutionary technology, always overshoot. The dot-com boom was based on the internet, which was real and changed the world, but the stock still crashed 90%. Today, we have a situation where the stock market is priced for perfection, while the bond market and the real estate market are screaming disaster. You have a divergence. The paper economy of stocks says everything is booming. The physical economy of buildings, shipping, and manufacturing is flashing red warning signs. This disconnect cannot last forever. Eventually, reality wins. The trigger will likely be the banking sector. When those regional banks in the US are forced to digest the losses from commercial real estate, they will pull back on lending. When lending stops, small businesses suffocate. When small businesses suffocate, unemployment rises. And when unemployment rises, the consumer stops spending, and the earnings of those high-flying stock market darlings come crashing down to earth. The $10 trillion figure isn't just a scare tactic. It's an estimate of the wealth that stands to be wiped out when asset prices correct to their true value. In China, that correction is already happening in slow motion, grinding down their economy. In the US, we are frozen, waiting for the first big bank to crack under the weight of bad office loans. So, what happens next? We are likely entering a period of the great repricing. Assets that were inflated by cheap money, whether it's a Class B office building in downtown Chicago or a speculative condo in Shenzhen, are going to find their real floor. It will be painful for those holding the bag. But for those paying attention, this is also the moment of opportunity. Cash becomes king. Liquidity becomes the most valuable asset you can have. While the institutions scramble to cover their losses and the governments try to print their way out of the hole, the volatility is going to be extreme. You need to look past the headlines about the latest AI chip or the daily stock market rally. Look at the empty windows in the office towers in your city. Look at the news coming out of China's shadow banking system. The structural breaks are there. The bubble hasn't just formed, it has already been pierced. We are just waiting for the air to rush out. The next 12 to 24 months will likely define the economic landscape for the next decade. The $10 trillion bill is coming due, and the only question left is, who is going to pay it?